Thanks for checking out this module in the Veripax Investment Training Series. This module deals with stock investing and is part 2 of 2. So this is where the good stuff gets talked about. I'm Jerry Versiput, President and Principal Investment Advisor for Veripax Financial Management. In this module, I'm going to get into the specific strategies that we use to implement the stock portion of portfolios. And as with all these training modules, nothing I say should be taken as investment advice. If it sounds like investment advice, it's actually not. It's just my opinion. To get things kicked off here, I wanted to do a quick recap from part 1. One of the things that we talked about was that stock investing is not a competition. It's just another tool in our toolbox to help try to accomplish financial goals. Also, we took a look at the correlation between the major traditional asset classes for stocks, so large companies versus small companies and US versus foreign. And we saw that there's actually very little diversification that's happening. All of these different asset classes tend to correlate with each other very highly. At the end of the presentation, though, I did mention that if you don't want to use professional management, then using some low-cost index funds are a perfectly reasonable way to invest. You may not get any risk protection, but at least you're not wasting money on useless management fees. And then the last thing here I wanted to touch on that we discussed last time is that anytime we do risk management, although that can help avoid big losses, there will probably also be periods where we underperform the market when stocks are on a tear. And so balancing risk management and investor emotions is very hard. One last thing I wanted to just highlight is that what did work in the past may not work in the future. We just take a look at the correlations today of those major asset classes that didn't correlate nearly that highly, say, 20 years ago. But the environment is constantly changing. The environment is certainly different today than it was 20 or 30 years ago. So we have to accommodate those, but also take a look at the truths that remain consistent through everything. I think it's important to understand the role of stock investing in the context of everything else that we might be doing in a portfolio. So what we're seeing here is what's called the Morningstar Style Box. And this is a very common matrix that helps us understand traditionally how diversified we are. So on the left-hand side, you have large companies, small companies, and in the middle there's mid-sized companies. Across the top, we have what would be considered value stocks versus growth stocks, and sometimes it's hard to tell, and so there's a blend in the middle. And the idea is that if you have stocks that are spread out throughout this matrix, then you are diversified. So if we're going to put together a portfolio, we're going to figure out, well, how much, what percentage of large cap stocks do we want, and do we want more value or more growth? So just hypothetically, we'll say we want about, say, 60% in large cap. Most portfolios would consider large cap stocks to be the core of their portfolio, so they're going to have a higher percentage. And in this case, we're going to skew it a little more towards value because some studies have shown that over long periods of time, value stocks tend to outperform growth stocks. So these all represent the percentages of the different types of stocks that we would have in a portfolio. And now we also want to take a little more risk and maybe have some small cap stocks. We're not going to have as much, but maybe 15% would be a good percentage. And again, we'll skew it a little more towards value. And then we just fill in the rest with mid-cap stocks, mid-sized companies. So here we have our stocks spread out over the entire Morningstar Style Box. And this is what would be traditionally considered diversified. But we saw in the last module that this is not diversified, that actually when you look at how much all of these different types of stocks perform together, in other words, their correlation with each other, that they all correlate in the 90% range, or certainly all of them are 80% and above over a 10-year span. So we're not really getting diversification, even though this would be considered to be traditionally diversified. So let's take a look then at how this fits into what Veripax would consider to be diversified. And we take this, and what we say is, well, this is one tool in our toolbox, and therefore it fits in one of these squares. And that would be considered stocks. And in fact, it's unhedged stocks. I'll talk about that in just a second. But we don't want to stop there because that's just one asset class. We want to have things that do different things. And so we might also add some stocks that are hedged, meaning they have some downside protection. And then we're going to start filling in this matrix with all different kinds of asset classes that all make their money in different ways. And so this kind of gives a picture of how stock investing would fit into a portfolio that Veripax would create. And the key point here is that stocks are just one tool. And we have many tools to help accomplish our financial goals. Stocks are just one. All investments use some form of risk in one way or another in order to earn their return, and stocks happen to use market risk. For the traditional stock investing piece of our portfolio, I added in this term unhedged. So I wanted to just take a second and talk about what I mean by that. A hedge is just a barrier. When you think about a hedge that you plant between your yard and your neighbor's yard, it just provides a barrier between the two yards. And so kind of the same thing for stocks, although in stocks it's providing protection to the downside. So it's protecting us against loss. And therefore, unhedged stock simply has no protection. And that's what I mean by unhedged. Even though it doesn't have any downside protection, there's actually a benefit, and that's that it responds to the daily movements of the market. So when the market is going up, we can take a look at the portfolio and we can see these things gain in value. Now, the way that I think about this is that stocks are typically considered to be a long-term investment. If you know that you need your money within, say, 5 years, the stock market is probably not a good place to park your money because it's then subject to loss. So if stocks are considered to be a long-term investment, do we really need to have them moving every day with the market? And in some cases, yes. One is it simply provides an emotional benefit. When the stock market has a big up day, we like to take a look at the portfolio and see that something in our portfolio made money that day. And also there can be unforeseen needs for liquidity within some time frame, and so we need some portion of our portfolio to always be liquid so that we can just sell stuff and get money out of it. But it's in terms of earning a return, having investments that respond to the daily movements may not be the best idea, but we still need to have some in the portfolio. So given that, we then need to decide, well, what are we going to have? And like we said before, we might start off with large cap stocks. How much growth, how much value do we want? Once we determine that, we're going to need to fill out that Morningstar Style Box. So we might spread our money over these different styles of stocks. Once we have that all filled out, well, we want to diversify into some form of foreign stocks, maybe some developed countries and then emerging market countries. And then we could say, it looks like energy stocks are undervalued, so maybe we want to add a fund that just holds energy stocks. But there's several different sectors in the market, so if we start adding some of those sectors, then maybe we think of some individual countries that might be undervalued, so we want to add in some individual countries. If we're not careful, we can end up with a portfolio that's just a mess. So because of the correlations that we saw between a lot of these different styles that we saw in the first module, I really don't think it's worth the effort to try to spend too much thought on how much growth, how much value. One simplification we can do is just say, well, let's just pick some large cap stocks. And a large cap blend fund, as an example, might be just the S&P 500, just a simple index fund. And we saw between mid-cap companies and small-cap companies that the correlation was extremely high. I think it was 97%. So really not a reason to spend much thought on that. We can just get a fund that mixes some small and mid-cap companies together. I do like the idea of having a mix of developed countries and emerging foreign countries, but it's probably not worth the risk of individual country concentrations. It's just too much that can happen in a single country. And if you have a smaller portfolio, we could just end it here. This gives us a good mix of US and foreign and lots of different size companies, and this could probably result in a pretty diversified portfolio. For larger portfolios, I might go ahead and add in some sector-specific funds. Right now, maybe energy, financials, materials, some of these others have a better chance of doing well versus, say, utility stocks, which tend to not do as well in a rising interest rate environment. But this is not necessarily, well, not always necessary. You might get some incremental benefit by having sector-specific stocks or overweighting in certain sectors. But anytime you do that, you also run the risk of calling it wrong, and then it detracts. So it's a risk benefit. Ultimately, though, by simplifying here, we get some very low-cost exposure to stock indexes. We're not having to pay for managers to pick stocks within these different styles. We just want some low-cost exposure, and we want them to respond every day to the movement of the stock market. And in order to accomplish that, we really don't need to be overly complicated. This may seem obvious, but if we have a category called unhedged stocks, then we probably would have a category called hedged stocks, and that is the case. And what we mean by hedged stock is just some form of stock investments that do have protection to the downside. So I'll talk about a couple of those that I use that are just in the form of mutual funds. Anybody can buy these. The first category is what's called long short. It's probably easiest to explain this by drawing a picture. If we're long stock, what we mean by that is that we simply own stocks. Anytime you own stocks, another word for that is being long stocks. And long stocks obviously earn their returns when stocks go up. If we short stocks, well, then we can make positive returns when the stocks go down. So on a long short mutual fund, when they go through and do their stock screens, they might find the stocks that are most attractive to buy, and they buy those. But in that process, they're also going to find a group of stocks that look overvalued and are likely to go down, and so they'll short those. And what ends up happening when the entire market goes up, that short position is going to weigh down the returns. And so a long short fund is likely to underperform in a very strong up market. But when all stocks go down, they have a portion of their portfolio that's actually making money, and so they won't capture all of that downside either. So if it's a good long short fund, it'll tend to be less volatile. And if they're right, they should be able to grab more of the upside and lose less of the downside. And that means over time, these things have a potential of outperforming the market, but with much less volatility. And so that's why I like to use some portion of long short funds in a portfolio, and the downside protection is just this section of short stocks that they maintain. The other category that I tend to use, not a very interesting name, but we just call it a hedged stock strategy. There's one particular fund that I use for this, and it's just a mutual fund. In fact, it's a large cap stock fund. But then the fund managers hedge the downside using futures contracts for interest rates and currencies and other commodities. And they use that to protect the downside. They've been at this since 1997, and in that entire time, and think about this, that includes the dot-com crash, it includes the financial crisis. In that entire time, they had one negative year. And that year happened to be 2011. I'd be happy to talk about why that is. But so this fund, their hedges were effective even through the financial crisis. They were up about 5%. They were effective in every year of the dot-com crash, so they had positive returns in every one of those years. But it isn't always in sync with the market. There's been other years, 2013 would be an example where this fund was only up 2% and the market was up 32. So if you're going to have a strategy that protects to the downside, there will be times when it underperforms the market when the market is strong. And as long as that's a portion of your portfolio, that's just fine. When we look at it over the long term, in this case, the fund's inception was 1997. It earned an average annual return of over 11% versus just over 7.5% for the S&P 500. So if we're in stocks for a long time, I think it's important to try to protect that downside and not absorb losses. And then if you can find a fund that actually makes positive returns in those years, it's even a bigger benefit. This last form of hedged stocks is actually not stocks at all. It's actually debt obligations of major banks called structured notes. When we think of structured notes, you can think of a bond. They're basically the same thing, except that instead of a bond which pays simple fixed interest to lend your money to the bank, a structured note pays a more interesting return. So every major global bank has a structured note desk that tries to come up with more interesting returns to entice people to lend them money. And banks just need to borrow money constantly. Some questions I get asked quite a bit on these structured notes is, how is the bank making money? And the bank's not trying to make money. They're trying to borrow your money, and then they're going to go do something else with it in order to make money off of that. Another question is, well, how does the bank do it? The bank uses all kinds of financial instruments that are available to them in order to hedge their risk and allow them to give us a more interesting return. How they do it is proprietary and really not important. They're on the hook to deliver the return that they say they are. How they protect their own risk is not that important to us as investors. So when we think of structured notes, they can be very effective stock replacements. And they're just like any other notes or bonds. The only difference is that their return is more complex. I want to show an example of one of the structured notes in my practice that is used as a stock replacement. And in this case, it's going to be a replacement for U.S. stocks. So ultimately, the return after 5 years, has a 5-year duration. The return for the note is going to be based in some manner on the S&P 500 and Russell 2000. So this is a profit graph, and if we just invested in one of these indices, let's say the S&P 500, of course, if over that time period, the 5 years, if the S&P 500 is up, we make money. So if it were up 60%, we would make a 60% profit. And by the same token, if stocks go down, we would lose money. In the case of this note, at expiration, the note's going to give us our money back plus some return if the market is positive. And in this case, we would get what's called 157% upside participation, or 1.57 times the return of the U.S. market. So as long as stocks are positive at the end of 5 years, we get 1.57 times the return. But what if stocks are not positive? Well, if stocks end up anywhere between 0 and minus 50%, it's called a 50% barrier, we simply get our money back. So that's kind of nice. What happens if stocks are below 50%? Well, at that point we're sad because we would end up with the same loss as if we had owned U.S. stocks. No better and no worse, but it would still be sad. So, and that's would be minus the dividend. So there's really two costs to these notes. One is we're taking on a little bit of credit risk. In this case, the note is issued by Credit Suisse Bank, which is the second largest bank in Switzerland. These are senior notes, so they actually have less credit risk than all of the bank's bonds, but there still is credit risk. If Credit Suisse went under, these are unsecured notes, and so there's a potential that we wouldn't get all of our money back. Again, I think that's a pretty small risk. And then also, we do give up the dividend compared to actually owning the stocks. So if, for instance, stocks didn't go anywhere in 5 years, we would simply get our money back, where if we had owned the stocks, we would have made maybe 1.5% a year in dividends. I think that's a small risk to pay because of the leveraged upside. We would overcome that pretty quickly if stocks did go up. And if stocks ended up being down 10 or 20%, we would be more than happy to just get our money back. And again, this isn't the only note in my practice. I have other notes that will make money if the stocks market doesn't go anywhere over a period of time. So just as a summary on this one, we get leveraged upside at the rate of 1.57 times the return of US stocks, and we get 50% downside protection. So that's our hedge, is if stocks are down anywhere between 0 to minus 50%, we get all of our money back. If you're still with me, congratulations. We're going to wrap this up now. And first point I wanted to just reiterate is that if you're going to do this yourself, I think index investing is perfectly reasonable. It's low cost. There is no risk management, and there's a complete reliance on the stock market, but at least you're not paying unnecessary fees. And the reason why I have a hard time recommending some of these other funds that do risk management is that the sophisticated mutual funds often come with pretty big front-end loads. That's a sales charge that you have to pay when you buy it. All those front-end loads are waived for fee-only advisors like Veripax, but that's a big barrier to overcome if you're just buying this on your own. So that's why I would probably favor index investing. That's not a recommendation. It's just, again, my opinion. So how does Veripax do it? Well, we take a look for the stock portion of our portfolios. We kind of break those into three pieces. One is just going to be unhedged, low-cost, exchange-traded funds. These are liquid, and they respond to the daily market movements. Then we're going to have another piece that's going to be hedged stock funds. So these are also liquid. They can be sold at any time, but they do have better long-term return characteristics. They're just not always in sync with the daily movements of the market or even the annual movements of the market. But over time, they tend to have better long-term characteristics. And then finally, we tend to use these structured notes that are used for stock replacements. I can place the risk right where I want it, where I think a portfolio has a weak spot. We end up with significant principal protection and often leveraged upside returns. But to realize the full benefit of a structured note, you do have to wait till expiration. It's not going to respond like that on day one. In fact, it probably won't see the full benefit even start to show itself until a year or so before expiration on these. But if we hold them till expiration, we get a lot of benefits. That does it. Thank you very much for taking the time to listen.